Today we've cut bank rates by 0.25 percentage points to 4%. There's been substantial disinflation over the past 2.5 years, supported by the restrictive stance of monetary policy. Domestic price and wage pressures have generally continued to abate in recent months, and that's allowed us to take another step today in reducing bank rates. But the picture is more complex than that. Headline inflation rose to 3.6% on the latest data for June, owing to increases in energy, food and administered prices. Now, we have been expecting this move up. Indeed, I referred to it at the last press conference we had in May. We think that inflation will increase to around 4% in September. Our job is to ensure that inflation falls back to the 2% target once these temporary factors pass, as we expect to see. So it remains important that we do not cut bank rate too quickly or by too much. Today's decision is based on three key judgments on the outlook for the UK economy and inflation, and our assessment of the risks around those judgments. The first key judgment is that disinflation in underlying domestic price and wage pressures is generally continuing, albeit to different degrees. Headline inflation is likely to pick up slightly further in the coming months, but we do not expect this increase to persist. The second key judgment is that a margin of slack has opened up in the UK economy, and the labour market is continuing to loosen. While we expect it to pick up a little in coming quarters, growth in the UK economy remains subdued. Employment growth is weak, and the ratio of vacancies to unemployment has fallen further. While real household incomes have risen over the past couple of years, consumption has not followed suit. The saving ratio remains notably above pre-pandemic levels. Consumers appear to remain more cautious than we have expected, perhaps exacerbated by broader downside risks to activity and the risk of more sudden adverse developments in the labour market. And the third key judgment is that the margin of slack will act against remaining persistence in domestic price and wage setting to return inflation to the 2% target in the medium term. The extent of the shift in global trade patterns and how this may come to affect external pressures on UK inflation remains uncertain. Recent domestic news suggests that the risks to inflation have shifted slightly more to the upside. The near-term peak is likely to be a bit higher than we previously expected, and the risk of second-round effects means that it may take somewhat longer for inflation to return to target. But at the same time, there are slightly more risks on the downside to activity. Economic growth is subdued, the labour market continues to loosen, and consumption growth may take longer to pick up. That in turn could lead to inflation falling below the 2% target further ahead. Do we put more weight on the recent pickup in inflation and the risk it poses to inflation persistence? Or do we put more weight on the risk that the recent weakness in activity could lead to inflation weakness further out? Well, the answer is that we set monetary policy to reflect our assessment of the balance of risks, and we set monetary policy in a forward-looking manner to return inflation to the 2% target sustainably over the medium term.